Okay. All right. I want to welcome everyone to the Forex Profits class. I am your master trainer, Angela Powerhouse Williams. This trade strategy was designed for you to be able to scalp an extra $50 to $100 a day, build your account over time because it's an in and out technique. But as you can tell by a lot of people's results, you can grab more than $100 out of market. You can grab 500, 1,000. 10,000, it really doesn't matter, especially when you're trading with the trend. So this is session 2, and we're basically going to be talking about the actual powerhouse strategy because I know we got a lot of new people. So that I want to make sure that everybody understand the strategy. And some of you have been in the class a couple of times, and every time I do it, it's always something different. Because as I watch you guys take trades and I notice certain things, I always add some other nuggets in there so that eventually you'll get to a point where you are a confident and a smart trader. Disclaimer, I'm not a financial advisor. I will not tell you what to invest in, nor pick stocks for you. This training is for educational purposes only. Please be aware that all trading transactions can result in potential loss, and you should only be trading with disposable income and not leverage more than you can afford to lose. Information disclosure: you may not discuss, share, reproduce, copy, reprint, modify, rewrite, create, distribute, publicly display on social media, publicly perform, license, or sell content retrieved or learned from this presentation without the express prior written permission of myself, Angela Williams, owner of Radical Investments LLC and Financial GPS 360. In order to have access to this class, it is by invitation only. So if you know anyone who might be interested, please reach out to me. Now, from our last training, I introduced you to the concept of trading Forex, and your homework assignment was to make sure that your brokerage account is set up. So by this time, everyone should have went under files, downloaded the set up your demo account procedure guide, and set up your demo account with Hugo's Way. You should have anywhere from 10,000 to 100,000 paper account already set up, leverage 1 to 500. Also, once it's set up on your desktop or your laptop, you also want to go ahead and make sure that you download MetaTrader 4 to your mobile device. You know, last week we spoke about your mindset and your vision, and how your mindset represents 90% of trading, you know, how you feel. And everybody posted in the group what their financial goal was. Some people wanted 5,000 a month, 10,000 a month, 25,000, 30, 50, 100,000 a month. And so now what needs to happen is, in order for you to get that shift in income, you got to change. So that means that everything you've been doing, it needs to be out the window, because that wasn't getting you to 50 to 100,000, right? And so you're going to have to think different. And what you're going to have to start saying to yourself is, okay, I am so happy and grateful now to be making $50,000 a month. I'm so happy and grateful now to be making $50,000 a month. You need to be speaking nothing but abundance over your life all day long. Continue to look at your number. Make your number you said you want to make $50,000. Take a picture of that piece of paper. Make sure it's your screensaver on your laptop. Make sure it's your screensaver on your phone. Post it on social media so you make yourself accountable to everybody, not just me. And from this point on, you let your family know this the goal. This is what I'm working on. And so everything about you got to change. And what has to change is your discipline and you understanding this strategy. And so once I teach this strategy, if you were to be consistent with it, if you are to follow it, you are going to be able to turn what you're dreaming about into money in the bank. Okay, because I'm telling you now, if you want to make money, but you still want to do the same thing, you ain't gonna never get there. Okay, so everything is about abundance. I'm so happy and grateful now to be making $1 million a year. I'm so happy and grateful now to be firing my boss. And you're saying that, and I want you to feel, how would it feel if you was making $50,000 a month for trading? How would you feel? What would you be doing? Where would you be going? What type of feeling would that give you? That's the type of feeling I want you to have right now until you get there. And every time it get a little rough, it's okay, because you know what the end goal is in mind. So make sure them goals is in front of you. That is your vision. I'm so happy and grateful now. I am so happy and grateful now to be making $5,000 a month, because God supplies all my needs now. I'm telling you, I say that all the time. God supplies all my needs now, and it happens. That's how you take what you're thinking about and make it into reality. So you got to see it, you got to hear it, you got to believe it, but you got to do the work. And so now we're going to get into the work. You know that we are trading the indices, because I said I trade the cake. So 90% of all my trades are in indices, because I trade the markets, the overall markets. So it doesn't matter if a company doing good. It doesn't matter if a company does bad. Is that company going to affect the indices? Yes or no? And I'm just going to trade where the price action is going. So when you are trading, you are starting with the SPX 500. It is a little bit slower market. The US 30, which is the Dow Jones, it moves faster. It also pays out faster. But just how it pays out fast, if you're wrong, you lose money fast. Okay, so you just want to add them all together. So you can start with SPX 500. Then you can go to NASDAQ. Because the great thing about NASDAQ is NASDAQ, we know, is filled with the internet stocks. So the Facebooks and the Amazon. So NASDAQ pretty much be in a bull run most of the time. So it's a whole lot easier to trade the NAS 100. So you literally can do the SPX and the NAS 100 at the same time. As you build your skill level, as you understand the strategy, then you start incorporating US 30. When you go live, start with SPX 500 and NAS, then go into US 30 until you got your win percentage up at and you've grown your account. Then you could switch to US 30. Start your lot sizes small so that you can win consistently, and then increase your lot size. Again, you could also trade gold. You know, as the markets go down, gold goes up. So if you were looking at those charts, you should have seen the difference in how gold traded versus how the overall market's traded. We got the dollar futures, and then of course we got the Bitcoin. The Bitcoin is very sporadic, but most of the time when I look at Bitcoin, it's on a weekend, because the indices are closed on Saturdays, okay? The markets are open from Sunday to Friday, closing Friday at 3 p.m. Central, 4 p.m. Eastern. Again, there are certain times when there is more money and volume in the marketplace, because you only really want to trade when there's money. If you're trading outside the money times, you'll find yourself trading in choppy markets, and you'll end up losing. And so the money times is between 7 a.m. to 9:30 a.m. and this is Central Time, 2 p.m. to 3:15, 5 to 6 p.m., 9 to 10 p.m., 1 a.m. to 3 a.m. What you'll also notice in the markets is how the market how the week starts off. The opposite usually happens toward the end of the week, toward the middle of the week. So if on Monday the markets are down, usually on Wednesday or Thursday the markets will start moving up. If the markets were moving up Monday, which they were, so if the markets was up in a bull run Monday and Tuesday, you will start to see a pullback around Wednesday and Thursday, which is pretty much what you're seeing right now. Friday usually be a up or down day, kind of like a choppy day. That's why I never trade Fridays. Sometimes you'll get lucky first thing in the morning, but if you're still trading all the way until the afternoon session, it usually gets real choppy and you start to lose money, okay? Now, one rule of thumb when it comes to trading, I want you to understand to, number one, take your emotions out of trading. I need you to completely detach your emotions to the money. Win or lose, detach. Just stick to the system, okay? Because if you lose, you'll get emotional and you'll feel like, oh, I don't know if I want to get this. I don't know. Maybe I should give up because you're losing money. You got to understand, in order for you to win, you got to lose. There is not a trade strategy on earth that is going to allow you to win 100% of the time. The point is for you to be able to manage your risk so that you're not losing big and you're not blowing accounts. Okay. But losing is part of the process. You're going to win some, you're going to lose some. My strategy wins 80% of the time. So what does that mean? That means that 20% of the time it doesn't win. And so the times that it doesn't win and the trade maybe reverse on you or what have you, get out the trade. Don't hold the trade open waiting for it to come into your favor, because most of the time it never does. Also, never take a trade based on what you think. Never trade on what you think and how you feel or where you believe the market may be going. Here's why I'm telling you this. We are trading and we are up against some heavy hitters. There are experts in this market that manage billion-dollar portfolios that are trading in this marketplace. And just how we're going into the markets trying to take some of their money, guess what? They in the markets trying to take yours too. So don't ever think that you know what they thinking, what they want to do, because there are market makers. And market makers have the ability to move the market in a certain direction completely against you. And so don't just jump out and take a trade and say, because I know it's going to go here and then it's going to go up, so I'm going to go ahead and I'm going to get out here. Don't do that. Trade based on what they are showing you exactly where they at. And we're going to be talking about that tonight. So again, it ain't about what you think. It's what the market is saying to you. So to make sure that you, first thing when you get ready to trade, you always want to look at the economic news because it can impact your trading. So if you are trading currencies, you know, the EUR, USD, or the UAD, USD, any currency pair that you want to trade, you want to make sure that you go to Forex Factory. When you go on the Forex Factory, because you want to know if there are any announcements that is going to affect a country's currency. Now, once you go to forexfactory.com, you're going to see like a date. When you see this date, that's basically letting you know the economic announcements that's going to be happening, and it's broke down by the day. But what you want to do is you want to go to the right side, and you're going to see like a little funnel. When you click this funnel, you're going to be able to filter out economic data for whatever pairs you are trading. So obviously, if you are trading USD, CAD, then obviously you only want economic data that's going to affect the US dollar or affect Canada's currency. And so you're able to filter that. All right. And so in this example, I was looking at the EUR USD, so I just did the filter, said I wanted to see EUR USD, and that's all they are going to show me. Now, one cool thing about the Forex Factory is that they have what they call impact folders, and the folders are color coded. And so when there is an economic announcement that could really have a huge swing in the markets, the envelope is going to be red. Now, this is not red. This is like an orange. So it's kind of like yellow, you know, for low momentum. We got orange for medium momentum. And then if you see a bloodshot red folder, that means that that has the ability to shift the markets. And so obviously when that happens, you want to make sure that you got the time, and you might want to give yourself an alert on your phone so that you know you're not in a trade when an economic announcement is about to happen. Now, if you're just trading the indices like myself, I use Market Watch because Market Watch is geared to the U.S. markets. And what I did find that with Forex Factory, when it came to U.S. economic information, some of the things that they had color coded for medium momentum would actually be high momentum in the U.S. market. So the best place to go if you're trading the Dow, the S&P, or NASDAQ is Market Watch. If you're just trading currency pairs, use Forex Factory. Okay, so again, I like to go to Market Watch. I like to see what announcements are going to be coming up, and I want to know the times. Always remember that Market Watch is in Eastern Standard Time. So if you see 8:30 a.m., that's really 7:30 a.m. if you are Central Standard Time, like myself. Okay, so I'm going to always go see what it is. If it's something major, obviously like jobless claims, if the Fed's going to talk and things like that, I just make sure that I give myself a little, I actually set my clock. That way it rings because it's easy to get sidetracked, to know that if I'm in a position, go ahead and close out because an announcement is about to happen, and to pay attention. You'll also notice that usually when there's about to be some economic information, the market will start trending in one direction prior to it. So sometimes if they think that the jobless claims is going to be bad and they want to bring down the market, they usually move the market up so that they can have the price high, have everybody jumping out there thinking that the price finna stay high, and then they'll pull it down because of the economic news, and then bring the price lower to the bottom so that they can buy a wholesale and ride it back up. Okay, so you'll notice that if you start paying attention to the announcements and looking at your candles and seeing how it works. Again, whenever I am trading, I always have CNBC playing live because anything that's political with the president, just like the other day, the reason why the market started to fall is because there was a comment that the China trade deal was off. And so that made the markets started to fall down. Then they reversed it the next day. But then now, you know, because there's new outbreaks of the coronavirus, the market is starting to fall down again. This is such a weird trading time because when the virus first hit, the markets tanked. And then after that, it just shot up. Even though news was bad, people was losing jobs, the markets was still straight up. And I believe it was because of retail traders that are jumping in the markets trying to buy low, which made the market just completely do a V. You know, so it's just uncharted territory. So you just want to be mindful. And again, don't place a trade thinking you know where the market is going to go after an economic announcement. Because I have seen it where it used to be when jobless claims was high, the market would fall. But in the last couple of months, jobless claims would be high and the market will still go up. So again, don't take a trade thinking you know where it's going to go. Let the market come to you. If you're trading in the aftermarket session, which is after 5 p.m. Central, CNBC actually will be off because I think Kramer might be the last person that up. I think Kramer comes on at 5, and then at 6, I think it goes to, you know, something else. So I turn to Bloomberg News, and when you turn to Bloomberg News, you'll see the real-time economic information. Here again is an example of why you don't want to be in the markets. So this is an example of price market was just moving, it moved down, and then it started to move up. And then you might think, okay, price action, finna move up. So I'm finna go ahead and I'm finna do me a buy. That's what I'm finna do. I am finna to buy. And what'll happen is you'll find yourself in a buy position, going long, and then an economic news announcement will happen and the market will shoot straight down on you, but you were in a buy. And so this long candle right here, you only see candles like this when bad news happen or something happens. If you see a long red candle, something happened in the news. Something major happened in the news or the president did a tweet. If you see a long green engulfing candle, something amazing happened in the news, like a stimulus package. Okay, so be mindful when you see these big old gigantic candles, it usually represents that something happened in the news. Now, what I'll also tell you is, again, don't chase candles. Don't trade based on where you think it's going to go, because you don't know. What I will say is, usually when there is a strong move from the upside or the downside because of economic news, the market will always retrace and go back to where it was before the economic announcement. So obviously something bad happened. The market fell all the way down. It went all the way down to here. And then it reversed and started to move its way back up. And I guarantee you, by the end of the session, this price action moved all the way up back here. And that's usually what happens when there's an economic announcement, okay? Whether it's jobs, whatever is happening. In order for it to go down and stay down, it has to be something major. Like if the country say, if the president and them say, okay, we got to shut the country down again, then you're going to see a massive drop, and it ain't going to be making it back up. Okay, it's just going to be a massive drop, and it's going to be lower than what it was back in March. Okay, so let's talk about the technicals. What this is this is a chart. Once you get set up on MetaTrader and you pull up an asset class, this is actually a chart of the Dow Jones market. So this is the US 30, and this is a 5-minute chart. And what you're going to hear me say a lot is pay attention to price action. When I say price action, what I mean is a candle. This is price action. So whenever you hear me say, when price action cross above the 50 and the 200, I'm talking about the candles. All right. So when the candles are red, that means that the price is going down. When the candles are green, that means that the price action is going up. I don't know why my spotlight keeps messing up on me. Yeah. Okay. So when it's green, the price is going up. Now, each candle represent price changes in a particular time period. So in this example, this price action is based on the 5-minute chart. Now, you are taught in my strategy to take your trades on a 5-minute chart because we are scalping. We're in and out, right? But we all know that you catch a breakout trend, that in and out can go for a long time. You can make some good money, right? But each candle here represent price fluctuation in a 5-minute time period. Okay, so if I'm down here and I want to know what happened 30 minutes ago, 5, 10, 15, 20, 25, 30, 30, 30. So this is where price action was 30 minutes ago. So each candle represent price going up and price going down in that 5-minute session. Okay, so just so you know that. So even if we're looking at this long green bullish candle, just know this entire move from the bottom side at 24,152 shot all the way up to 24,215 in a 5-minute time period. Now, next week, we will go over in detail candles, what they mean, candlestick behavior, but to just keep it simple. Red means down, green means up, and each candle is going to fluctuate the prices up and down every 5 minutes. So when a candle opens, you can literally set your clock on your phone, and in 5 minutes, that candle will close and a new candle will form. But again, this is price action. So when you're looking at the charts, price don't shoot all the way up. price pretty much goes down, goes up, goes down, goes up over time. And so what we're doing is we are using some indicators to help us gauge where the price action could possibly go in the future. But at the end of the day, when we take our trades, it's based on the candle. It is based on a candle because every indicator, every alert system is a lagger because every indicator is based on previous activity. There is nothing that is real time. And anybody that tells you that, they are a liar. It does not exist. The only thing that is real time is an actual candle. Always remember that. So the first thing that I want to talk about is how the markets move up and down. So I want to talk about market structure because when you see this, this is going to make you a smarter trader because I, again, have been looking at where you guys are getting in and getting out. And so I want to make sure that I talk about market structure. When you get ready to trade and you pull up your charts, you will be able to see the type of structure that the market is in. Now, I use 3 different scenarios when it comes to me understanding what the market is doing, okay? So the first strategy, I call it the paint roller strategy. So how to know if you're in an uptrend. So with an uptrend, price action, meaning a candle, is always going to start from the bottom left at a lower price. And price action is going to move up, which is a bull move up to the upside. And then after every move up, there's a small pullback. So price action started at the bottom, it moved up, and then there was a pullback. After the pullback, the market will continue to trend to a higher high. What's a higher high? Well, this was the first high. Then there was a pullback, and then price moved up. So you got more green bullish candles moving up. And when it got to this price point, it did another pullback. So this was a higher high because it moved higher than the previous high. It also created a higher low because here the price moved up, it pulled back, it stopped, it didn't fall all the way back down to the beginning price. It just a small pullback. It pushed up, created a new high, and then we did another pullback, but this pullback is higher than this initial one. So that means we got a higher high and we got a higher low. And then what happens? The trend continued. So it went up more and went to a higher price, creating a higher high. It did a pullback, creating a new higher low, and then it broke out again and continued to move up. That is how you can recognize an uptrend. And I call this a paint roller because that's the best way to understand it when you look at the candles. So think of you painting a wall and you got one of the rollers and you put paint on it. You know how you paint up and then you pull it back down and then you paint up a little bit higher and you pull it down? That's how I want you to think. So when you look into the market and you look at those candles to know if you're in an uptrend, do you see a paint roller? Do you see the paint rollers? Okay. Now, the opposite happens in a downtrend. So in a downtrend, price action, meaning the candles, the price, is starting from the upper left-hand side because it's starting high. The price is starting high. And so then price starts to break down. You know, the bears jump in the market, they pull the price down to here, they create a low, and then they pull back or retrace back, and they create a lower high because this was the first high. Now there's a lower high. After this, it went back to continue the downtrend. creating a lower low, because this was the first low and this low is lower, right? And then it did a little retracement and pulled back, created a lower high, because this was the first one, a lower high. This one is lower than that one, okay? I don't know why my thing keep freezing on me. Don't want to let me be great today. Okay, and then it goes back down to a lower price point, retrace back, create a lower high, and then fall all the way down. So that's how you know you're in a downtrend, because the price action started high, and then the candles start to fluctuate lower, up, lower, up, lower, up. Okay, that's a downtrend. So again, it's a paint roller, but it's the opposite direction. So you're taking the paint roller and you're going down, then you push up to make the paint a little bit thicker. Then you go down a little bit more, and then you go up to make it a little bit thicker. That's how I want you to look at the market. When it's an uptrend, it could be the paint roller. Downtrend, again, it's the paint roller. The second way, the second way that you could possibly see an uptrend and downtrend, this is my favorite. And I call this the staircase because it is the easiest to recognize. So in an uptrend, again, price action starts at the bottom at a low price. And price action moves up, and then it looks like all the price action goes sideways. It's moving sideways, almost like in a little channel. And then after going sideways, the price action break out and it go up some more. Move sideways, go up some more, move sideways, go up some more. This is the easiest trending structure that is out there. When you see this, it is money where it's going. The same with a downtrend. It starts high, it breaks down, it moves sideways, create a lower low, move sideways, create another lower low, and move sideways. I love to trade staircases because you already know where it's gonna go after it moves sideways. You just gotta wait for the breakout, okay? The next move is if you look at the market and it looks like price action moved up, it moved down, it created a higher high, it moved down, moved up, but it didn't create a higher high from the previous high. Then it fell down, went way right here, but didn't all the way touch the bottom. Then it moved up, fell down, moved up, didn't go all the way up, fell back down, moved up, and y'all saw this, especially last week. It was crazy last week, and then moved down. So what trend is that? It is not, you don't see no rollers. It's not going up, pull back, up, pull back, up, pull back, up, pull back. You don't see any staircase, up, sideways, or down, sideways. All you see is almost like a little kid in kindergarten, just squiggling some lines up and down. But the price action seems to be moving in a channel. You see this here? If you drew a line, a horizontal line across the price action, you'll see that the price action crossed the top zone 2 and its resistance. You can literally draw a line underneath where the price actions end and you see support. So it's not a breakout move to the upside. It's not a breakout move to the downside. It is literally moving sideways. And so for some people, they'll call this distribution. Some people call it consolidation. I call it choppy. And the best way to be able to know when the market is moving sideways is usually the price action be in between the moving averages So the candles are right in the middle of the two lines, not above them or below them, but in the middle. Or the lines, the moving average lines are very close together. Or if you zoom out on your charts, you'll be able to quickly identify a trending market from a consolidation market. And so usually as a new trader, I will tell you when the market is choppy, the market is moving sideways, do not trade. Sit back and wait. Do not trade. Because if you do not understand that you're in a choppy market and you trade it, that is why the price action to get right here and you do a buy. And as soon as you do a buy, because you think it's finna break up, it falls back down on you. And then you say, okay, so when it fell down, let me go ahead and sell. And then it goes back up and hit it again. That because it's choppy, there's no trend. And so that's why you get in a trade and it reverse on you immediately, is because you haven't identified that the market is moving sideways. Now, I love seeing sideways markets because what I know is that, remember, after every sideways consolidation distribution market, after that is going to be a breakout, either to the upside or the downside. And so all you got to do is trade the breakout, get on the train and ride it instead of trying to trade consolidated markets. Okay, because once the breakout happens, it goes into accumulation phase, right? And so if I'm looking at this and it looked choppy and I'm drawing my channel, it's looking like it's moving toward the downside. But I'm not going to place a sale just because I think it's going to the downside. I got to wait till this price action actually breaks this level of support, go back and test this level of support, freeze, and then I'm going to short the market and follow it on down. Okay. Now, I just want to share a little secret tip for those people who still want to practice trading and want to trade in a sideways market. Then one thing I will tell you is that you can use a lower moving average time period. And I'm going to talk about that in just a second. But also, if you zoom out your, go to like a higher time frame, so because we trade on a 5 minute. So if you looking at a consolidated choppy market and you trying to figure out why it won't break down more because you think that's where it's going to be, if you go up a time frame, so if you go to the 4 hour, because the 5 minute is a lot of movement, you know, they 5 minute candles, okay, like they say, and make a lot of noise. When you go up to the 4 hour chart, you'll be able to see the strong support or the strong resistance, which is why it will not trend for you. So sometimes you just got to look up to a higher time frame market so you'll be able to do that. You're going to know that in just a second, Dominique. Girl, I only got glasses when I'm reading. So, okay. So let's talk about when the market changes. Okay, so that's what we're going to talk about. Knowing when the market structure changed, because remember, we were in an uptrend. Okay, and so you want to know when you are in an uptrend, when it's going to change. Okay, and so let's say starting on the left hand side, the market started to go up and it created a higher high and a higher low. And then it started moving up some more, higher high, higher low. Price action moved up, higher high, higher low. And let's say you in this trade, you got in this trade right down here when you caught that, you caught a breakout. So you've been in the trade and you just been going up, 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 and up. When do you know when the trend is going to break? Well, that's going to be simple because the price action was creating higher highs. Higher highs. The second there is a pullback and a new high is created, but it's not as high as the top peak here. That is your indication that market structure may be changing and that the uptrend may eventually break. And so this is your first indication right here. It created a lower high, not a higher high. So this wasn't higher than this. So it created a lower high. Then after it created a lower high, it fell down some more. And when it fell down, the lower low is lower than this previous high low. You see this right here? So you literally can draw a line right here. And now it created a new lower low. That is an indication that the uptrend has ended and a downtrend is about to begin. And so when the price action moves up for retracement, you can hit sell and you can follow it down. Or if you're in a trade and you've been in, not if you took a buy up here. If you took a buy up here at the top, which is something I tell you not to do because that means that you're chasing a candle. Because remember, when you're buying, you're supposed to be buying low. So you should have been down here when you initially got into the breakout. So you should only be buying after these pullbacks. So this is a buy. This is a buy. So if you get in a trade down here and you go up to here and you come out, let's say you close and ring the register, don't immediately go back in and hit buy. Let the market pull back, then you buy and move it on up, because you always want to buy lower than the high. Buy. You should have been buying here. If you buy up here, which means you're chasing a candle because you think the market is about to move higher, not because you know the market is going to move higher. Guess what happens? You get caught. And what happens is, instead of the market moving up, it started to fall down because it's ready to create a lower high. So if you were still in the trade here and it fell back down on you and you said, I want to hold it open because I know it's going to push back up. When it fell down here and when it went up right here installed, you better go ahead and get out and just go ahead and take your loss, because it's not going to push up. It's actually going to push down. Okay. Same thing with a bear market. Let's say the market's been going down. It retraced up, created a lower high because this is the high. It created a lower high, fell down some more, created another lower high. Price fell down way down here, did a pullback, fell all the way down here, right? So if you're in a trade, you're only selling off of the highs, because when you're selling, you're buying high with the intention that the price is going to go lower. So you're selling here, you're selling here, you're selling here, you're selling here. You're not selling here. This is assuming that the price is going to go lower. Remember, you do not know with 100% certainty where the price action is going to go. So don't try to guess where it's going to go. Just follow the money. So if you sell here, guess what? There's a pullback, but you assume it's going to come back. And then it pulls down, but it's a higher low than this lower low. That's letting you know, and you'll start seeing a bull candle start to move up. You know that the downtrend is now over with, and a new trend is about to start. Okay, so when many of you are doing your scenarios, okay, so I just want you to be able to know when you see it. That way, if you in a trade, you get out of a trade and hopefully you're not chasing candles so that you can be caught high. Because remember, they see every trade that you put out there. So if you jump out there and you do a buy because you think the market's finna move up, they can move, the market makers can move the price action down on you. Next thing you know, you blew your whole account, and then they're running right back out to where you thought it was gonna go. But you got caught because you're trying to foresee the future instead of just being in the reality and the right now and just riding the candle. Okay, so again, if you're looking at price action, again, green candles means price is going up. Red candle means price is going down. So again, right here, if I'm looking at this area right here, price started here at the bottom. So when price is going up, it always starts at the bottom of a green candle. So the price started at 24,262. And then price moved up in 5 minutes, and this candle closed right here at 24,295. So in a 5-minute time period, there was 33 pips. There was 33 pips in 5 minutes. Why do they care about your little money? Because it's a capitalistic society, and you are a trader, and they treat you like they treat everybody else. We are not special, okay? And again, you in the market's trying to get their money, so why can't they get yours? Okay? So again, you just caught 33 pips in a 5-minute candle. Look at this right here, price action went up, and it went to this highest high point. Then it started to pull down because you see consecutive red candles. Anytime you're looking at the marketplace, you always know you're in a uptrend or in a downtrend because you look and see which candles stand out the most. So if I was literally looking at this, I would know that the red candles are overpowering the green candles. You can look at it and you can see the red candles is more red candles back to back than it is green candles, and the red candles are even longer than the green candles. Okay, do you see it? So just first glance, open up charts, you should be able to know which candle is in control. And you'll know because each candle is going to move the price action in one particular direction. So because the overpowering candles is red, the price is moving down. It moved down, did a pullback, then it fell down, it moved sideways, it fell down, it moved sideways. What is this? Stairways, move down, move sideways, then it pushed up a little bit, but it fell back down, right? Move sideways. So right now, this market is still in a downtrend, starting here at 24,344 to down here at 23,995. So that was a complete downtrend. You're in a downtrend. 349 pips. 349 pips. And so actually you can catch 100, 200, 300, 500 pips a day in the indexes. Okay, in the indexes. We're going to talk about candle patterns next week. So yeah, as you can see, this is a downtrend. Now, this is the opposite, right? Remember, you're going, what candles are more in control? When you look, you see more green candles, then you see red candles, right? And you also are noticing that the price action is doing what? It started at the bottom here at 24.63. Then it started to move up. And then it got kind of choppy right up in here. Because you see it didn't move up, pull down. It moved up, pull down. So this is an example of a choppy. You see what I'm saying? It's like a little channel. And then all of a sudden, after the channel, it broke up. It broke up. And it crossed over this high here. Because price action moved down. Then it created a higher low. And then it moved down. And then price action eventually broke out, and crossed over here. Moved sideways. And then what did it do? It broke up. It broke up. Then it moved sideways, broke up, moved sideways, went up to this high of 24,365 before the market structure changed and it started to break down, move to the sideways, and this would be a lower high here. And this was letting you know it ain't going back up, okay? So from 24,663 to 24,365 of the price moving up, you are clearly in an uptrend, and you would have caught 302 pips. Just by identifying the market structure anytime you're getting ready to trade. What type of structure is this? Put it in the chat. Who knows what structure this is? Remember, one is called paint, one is called sideways, the staircase. What is this? Yes, 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 yes. Yes, 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 yes. Martina, Francine, Sandra, Chantel, you got it right. It's choppy. How you know it's choppy? Because what's overpowering? Is there a color-coded candle that is overpowering? No. It's just as many green candles as it is red candles. And see, some people, this is an example of a chart being zoomed in. It's being zoomed in where the candles are enlarged. And so in your mind, you see, okay, the candle was low here, and then it moved up. So we got to be in an uptrend. And then it was a pullback, and then it was a move up. But guess what? You think you're in an uptrend. You did a buy right here, and what did it do? Reverse back down on you. You have to zoom out. When you zoom out, you'll realize that the market is literally moving horizontally, left and right, and there's a channel. Price action won't break below this. Price action won't break above. It literally goes up and down within this little channel. So nobody has control. There isn't a dominating candle. If you look at it, it's choppy. It's red and green, red and green, red and green, red and green. Sideways, consolidation. Now, again, I don't recommend that new traders trade when you're in a sideways market, especially if you don't understand you're in a sideways market and you don't know how to trade a sideways market. But for those of you who are a little bit more experienced, or you want to learn how to trade in a consolidated marketplace, what the secret tip is, what you want to do is duplicate the chart that you have in your MetaTrader. So you're going to duplicate your chart. You're going to rename it choppy. Rename it choppy. And then what you're going to do is you're going to remove the 50 and the 200 moving averages, and you're going to replace it with the 8 moving average. And then you're going to change your time frame to a 15-minute. And as soon as a red candle crosses below the 8, as soon as it crosses, go ahead and hit sell. A green candle cross above the 8. As soon as it crosses, go ahead and buy. And again, this is only if you're trading a consolidated sideways market. Now, a second indicator that you can use to trade a choppy sideways market is Bollinger Bands. Bollinger Bands are really good when the market is moving sideways. It's amazing when the market is sideways because you buy low, selling high, real simple. Now, the only way you get caught is when the consolidation is over and a breakout trend is about to happen and you in the wrong direction. So like I said, for the newbies, when you see the market moving sideways, just watch, because after this is over, it's going to break out in one direction. And the longer the consolidation move, the stronger the trend move is going to be. So anytime you see consolidation, get excited because there is going to be some money right after. So let's continue to look at some price action before I get a little bit deeper into the strategy, because this is going to keep you from taking bad trades, all right? Because again, like I told you, no strategy is 100%. So the more you be able to look at the markets and see what it's showing you, you will know when to take your trade and when not to take your trade, okay? So if you're looking at this, price action went to its low, and then we got a long candle here. And again, we're going to talk about candles next week. But this is basically a reversal candle that lets you know that the lower price targets are being rejected and there's going to be a move to the upside. So it moved up, it moved sideways, then it pushed on up, a long candle. Then it started to form. This is another indication that a pullback is about to happen, followed by a doji, which always means the opposite of the trend. So here's your pullback. It pulled back. It created a higher low here, and then it pushed on up and created a higher high. So you know you in an uptrend. Higher highs, higher highs, higher highs. You already know you were in an uptrend. Then there was a pullback, and then what happened? It moved up. What you see right here, it stalled right here. So instead of price action going back up and going up and testing the high and creating a new high, it actually paused. And that's usually your first instinct of knowing it ain't gonna go up for a while. So there go your pullback. So if you buying right here, you got caught because it created a lower high. It's lower than this high. It's lower than that high. So as you can see, price is dropping. So it fell down, and then look, it got choppy. Red and green, red and green, red and green, red and green. That's how you know. And then all of a sudden, price action broke up, broke out of the little channel, and now it's going to make itself back up. And so this is a trending market because you either seeing the paint roller or you seeing stairs, okay? This is consolidation. Again, you cannot see it good unless you zoom out your chart so that you can see it. So again, a market is bullish when you got consecutive long engulfing green bull candles creating higher highs. The market is bearish when you got consecutive long red candles creating lower highs. The market is consolidating when price action is literally moving sideways in a channel. Let's look at some more. You can see that price action started at the top and then it fell down and it moved sideways. It fell down. You see these long red candles. So clearly we in a downtrend, right? Then there's always a pullback and then it resumes the downtrend. Now there was a pullback a little bit, but then it fell down, but it didn't create a lower low. It went back up again So it's in consolidation. You can literally draw a box because it's literally moving sideways, up and down in this little box. It's not going down, 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 or up, up, up. It's going down, up, down, up, down, up. Always look at the changes in the candles. That's how you always know when a market is moving sideways, because no particular candle is dominant. Okay. Now, if I'm looking at this, and like I said, not tomorrow, next week, we'll talk more about candles and candle patterns. What I'm seeing right here is almost a double top. It went up, it went down, it went up, which means it will break out when it decides it want to break out, and it did, and it broke out right down here. And then it reversed, did an engulfing bullish candle, and it moved up, moved sideways, it went up, it went past this, our high here is past our channel, and now that's telling us that the downtrend is broken, okay? But the best thing you can do is to sit back and look at it. When you sit back and look at it, you'll see the market come to you. Versus rushing to try to get money, you want smart trades. And so it's important that you just understand market structure and know when a trend is breaking so you don't get caught. See, most people, they missed that this was in consolidation. They thought, okay, the market went down, it moved sideways, it broke down again, or they up here buying, they bought right here, and really the market is consolidating. And then it broke down and they're like, oh, I missed it. It's breaking down. I'm a sell right here. No, you always selling at the beginning of a candle, not the bottom. And you are assuming and hoping and praying that price action will continue to go down. And because you don't know how far it go down or how far it's going to go up, you will lose more than you win. Okay. When you do this and you win money, you were just lucky. But if you keep doing it, it's going to catch you. All right. And so if a person shorted here, you in the red, and you holding it open, thinking it's going to come in your favor, not realizing it had created a higher high and it ain't even going back down. And so then you got to close out and you got to eat that loss. And so it's important that you still understand market structure, because that's going to prevent you from, one, over trading, and number two, is going to prevent you from trading false breakouts. So here's another example. Now this right here, the market moved sideways, it went up, it hit this price channel, and it broke through, but it fell down right on the line, and then a bearish candle, red candle came and brought the price all the way back down to here, moved sideways, pushed up, created a lower high, which lets you know it wasn't going back up. It's going to go down some more. And what did it do? It went down, created a new low. We got a reversal candle right here. We got a bullish candle. We got all these back-to-back, 3 back-to-back bullish candles. They call them white soldiers. Then it went from a white soldier right into an engulfing candle. So you already know that the price action for the moment has been broken from the bearish and making its way bullish. Went sideways, moved up, went sideways, moved up. And what did it do? It broke through this price point. And if you draw a vertical line across, because we're going to talk more about support and resistance, but this will be considered a resistance line. It broke through it. And for many people, they'll buy because the candle broke through the resistance. Nope. It fell down, red, it went down. That's letting you know that's a strong level of resistance. Remember I told you how you throw a ball up to the ceiling, the ball fall back down. It has to be a whole lot of momentum to get the candle to break through a resistance, stay above a resistance, go back and retest that resistance and make it support before you can go ahead and buy. But we're going to talk again about that next week. So price action went down, it went up, it hit this resistance again, fell back down, moved sideways, and you see how these candles was trying to break the box? You see how it break the box? That means these were solid candles that broke the box, but then went back in the box. A lot of people get caught by these. The market is consolidating, and the market makers are bring it down, make you think they finna drop. And as soon as you hit sell, they butts and reverse it, went back the other way. Went all the way back up, tested again. But guess what? It didn't hit the line like it hit. See, these other ones broke through, at least. This one went up, but it never broke through. So that's letting you know a lower high. That means that the momentum is starting to shift. And what happened? Price action fell down. It went all the way down. It moved back up and got right back in that little window. Went to the right, pulled down, faked some people out. People hit sell because they selling down here, chasing a candle instead of selling at the top. Then it went up. Then it went down. It went down. It went up. And then finally, it just broke down. The momentum came on out the system. Price went ahead and broke down, went into your favor, all the way down, creating a golfing candle, sideways, up. Do y'all see it? And like I said, that's why I said every day you should look at the markets and you should study your charts for an hour, and you will see it right in front of your eyes, how they move the markets around. And once you understand that, you're going to spend less time losing money and more time making money. Again, uptrend, up, up, up. Again, you got to zoom out, because if you got your candles zoomed in, enlarged, you cannot tell you're in a movement, you're in a consolidated sideways market. So you just trading, and it's just, and for some reason, it's not working in your favor. Even though you might be saying, okay, the candles are underneath the moving averages, it should be going down. Yes, but it does not work in a consolidated market. And so you have to know that. Zoom out so you can see. So if you zoom out, you will saw that the market was in a clear uptrend. It went up, create new highs, new highs, new highs, new high, new high. Then it moved sideways, broke up to a new high. Then it moved down, it moved up, which this move right here let you know it's going to push down a little bit more because it's lower than this high. So it pushed down, but it didn't go all the way down. It stopped right here, went up, went sideways, pushed up, went back to that same point it was prior, but did not go through. Down, up, down, down, up. You see, it's just in this little box, making its way back down to the same price point as before, and then moved its way on up until it was enough momentum and money hit the market to push it out the box. And when this candle went out the box and the body was still outside the box, and the next candle opened up and it's still outside the box, then you could have bought. And went up, it went sideways, it pushed up, went sideways, pushed up, it pulled back, moved sideways, pushed up, sideways, pushed up. And so if you look at the markets every single day, you'll be able to see what is happening. I use an 8 EMA. I always use exponential moving averages, but don't trade it if you are a new trader. If you are a new trader, I don't want you trading in choppy. You can practice on it, create another chart, practice on it, but I don't want you trading that when you, especially if you're trying to trade live. The only thing I want you to trade is breakouts. So somebody said they got lucky. Y'all better stop being lucky. Trade smart. So let's talk about the Powerhouse strategy. All right. So again, You're going to pull up your charts. And like I said, I will be having a video that I'll drop tomorrow, so you'll know how to set your charts up, how to have your indicators, so you'll be able to start getting in and out of trades. But there is a little checklist. The first thing that you want to do, and actually this should be 10, before this number 1, before that, the first thing you want to do is you want to meditate. You want to meditate. You want to get your mind right. You want to be in peace. You don't want no chaos or noise around you. You want to be able to concentrate. And again, you're going to be saying your mantra, you know, God supplies all my needs right now. Every time I take a trade, I win. I'm be making $50,000 a week. I'm so happy and grateful now to be making $50,000 a week. You know that's powerful, right? That's what you need to do. Get yourself geeked up and get excited about looking in these markets and grabbing some money. Then after that, you want to check the economic news so that you know if there are any announcements, set your alerts on your phone. Then you want to identify the overall trend of the markets. And so you're going to be using a daily time frame to know what the overall trend is. Then you want to determine the short-term intraday trend. That means the trend that's happening right now that you're getting ready to trade. So again, we trade on a 5-minute chart. If the 5-minute candles give you too much anxiety, move up your time frame and you can take your entry trades on the 15-minute chart, okay? Then the next thing I do is I map out my resistance and my support. And again, when I drop the video tomorrow, you will know exactly how I do that. But I map out resistance and support first on the daily time frame. So I go on the daily time frame. I mark off the high price points. I mark off the low price points. And then I mark off some lower lows or some areas where I'm seeing price action stalls at a certain point where I can literally draw a line across and there are more than 2 candles that actually touch that price point, okay? So I call that my critical price points. So when I draw lines on the daily, that's critical. That means if it ever hit those prices, there's going to be a market shift, all right? Then once I map out my daily resistance and support, the next thing that I'm going to do is I'm going to go down to my low time frame. And that could be a 4-hour or it could be the hourly chart, and look if I see any major resistance and support there. And then when I'm ready to trade, I'm on my 5-minute chart. I'm going to give you an indicator that is going to draw resistance and support for you intraday. So you're still going to map out resistance and support on your daily time frame. And then you're going to use this Fibonacci resistance and support indicator for your resistance and support. So it's already going to draw for you. It moves with the market. Then I look at my RSI, because my RSI lets me know if the market is overbought. That means that I might want to start looking for a uptrend to break. And it also lets me know when a market is oversold. That means that I'm looking for the downtrend to eventually reverse, okay? And then I do my entry. And I do my entries based on the moving average, exponential moving average, okay? So again, when I drop the video, you will see that. And when it comes to take profit, like once I'm in a trade, I get out of a trade based on resistance and support. And I also create my stop losses based on resistance and support. But once again, I might have higher money in my account. So like I told you guys last week, your risk management, your stop loss could be based off a percentage of your balance and not resistance and support. So you have to do what's best for you based on the amount of money that you have in your account. And of course, I track every trade. I track every single trade because that's how you get good. That's how you see the lessons. That way, when you blow money, or when you lose, when you lose a trade, there's always a reason for it. So if you don't write it down, you don't know that you're continually making the same mistakes. And so tracking it is going to also show your consistency. Are you trading every day? At least get 2 practice trades in every day. At least 2 every day, and track it. And trust me, you will get better. Again, if the market is moving in consolidation, don't trade. But for those, again, who've already been trading, you already experienced, you might be in the futures class, then you can trade a consolidated market because you know how. You can use the 8 exponential moving average, move up your time frame to 15 minutes if you want to do that. But again, I recommend all beginners and everybody, if you want an 80% win rate, don't trade consolidation. Wait for the breakouts. So let's talk about the strategy. So now we got this price action. We know market structure and things like that. There are 2 indicators that you are going to, well, actually, what? 1, 2, 3, 4, 5. It's going to be 5 indicators. Even though under the file category, I have a number of different indicators that people can import, you do not need to import all those indicators, and you don't need all them indicators on your charts. The only indicators that I really need you to have on your charts is the moving average, the Fibonacci resistance and support, the trend band, and the RSI. That's all I really need for you to do. Now, there is an indicator for candlesticks, but that was something that we'll talk about next week, so you can kind of get an idea of how the candle patterns create. But you do not have to have those alerts on your chart, and do not take a trade based on those alerts. You only take a trade based on the strategy that I am teaching you right now. So we are using the moving average. I'm using exponential moving average. And what we're going to be doing is you're going to place one exponential moving average of 50 and another exponential moving average of 200. And you are going to color code them. So you're going to make the 50 moving average purple, and you're going to make the 200 moving average gold, yellow, gold, however you want to do it. I think mine is gold, okay? And all the exponential average is doing is going to be looking at the last 50 candles and looking at the last 200 candles, right? But the exponential moving average puts more weight on the current candles. So even though I told you, remember I told you, all indicators are laggers. So that means you see they form after the candles have formed, right? But the exponential moving average gets you as close to the current candle than just using a basic moving average or a simple moving average, okay? So that's why I chose exponential, right? So again, here's how you take the trade. There's also a band that you are an indicator. It's the trend indicator that you're going to be adding to your chart. And this trend indicator is literally going to tell you what the current trend is. And the one thing you hear me say all the time is never trade against the trend. When you trade against the trend, you are counter trading. When it comes to counter trading, you got a 50-50 chance of being right. So if you want to stick to the 80-20, trade with the trend. So you know what the overall trend is by looking at the daily. And then you go to your lower time frame, your 5-minute, which is where you're going to be taking your entries off of. Now, what you want to happen is you want the trend for the 5-minute and the trend for the daily to be the same. Because if they both green, then you know you're in a real strong bull market. Just so you know. Now, if the overall market on the daily is green, but the 5-minute is red, you might be in a pullback at the moment. But always remember the overall trend is up. So don't expect a massive pullback. Eventually, it's going to make its way back up. So if I got my moving averages on my chart, I got my trend band, and my trend band is telling me that the market is green. It's a bull market. Now I want to take a trade. When do I take a trade? Now, I think for some people got a little bit confusing, because when I talk about the cross, the breakout, the cross, there's actually two trades in one. The first trade is when price action crosses over both the 50 and the 200 moving average. What is price action, y'all? Somebody type in the comments, what is price action? When I say price action, what do I mean? Yes. Y'all paying attention. The trend band is actually under the files in the Facebook group. Candles. All right, that's what I mean. Candles. So whenever a candle, and I'm using a 2-candle confirmation because I'm trying to avoid taking a false breakout. So here's an example. You see this bullish candle, this green bullish candle, it crossed from below the bands, the line, the moving averages, to the top of the moving average. And then it closed at the top. This candle crossed over both moving averages and it closed. That's confirmation number one. So there needs to be one candle, a bullish candle, that crossed above both lines, and the body closed above both lines. The second thing I'm looking for is that the next candle, when it opened up, is a bullish candle that opens up. And if it opens up above both moving lines, I'm gonna go in for a buy. Well, you see this, a red candle start to form. So X that out. I'm not taking a trade. Here go another green candle. Crossed above both lines, closed above both lines. The next candle, the second candle, when it opened up a bull candle, and it was above, the opening was above both of the lines. Now, I actually would take a buy here. Now, as you can see, price action pulled back a little bit. Well, that's okay, and you know why? Look at the market. It's moving sideways. You see it? It's moving sideways. But I know that the trend is green. So I'm going to leave it there. It's open. It pulled back a little bit, and then it made its way up, and then boom, all the way up, and I caught it. So when I am trading, I'm initially trading price action. When price action crosses above both lines, and I do a 2-candle confirmation, when the price action is above the 2 lines, you're going long. When the price action, like right here, for example, is below both moving averages, lines, what are you doing? You're shorting and you're going down. Okay? So price action above the lines, you're buying. Price action below the lines, you're selling. But what you're trying to do is all about timing. You're trying to catch the breakout. So if I come into the market and the market already up here, even though these candles are above the moving average, and I know that it's in an uptrend and I want to go long, I need to wait. Remember market structure. So it moved up, but you see the wick. So what you buy for? You just don't buy just because it's above. You want to take smart trades. You know that a wick has formed, and then you see a doji, so that's letting you know it may not be pricing up. So what is it going to do? It's getting ready to pull back. And when it pulls back, it usually is going to hit the 50 moving average and then continue the uptrend to the upside, almost like a reset. And so even though I came into the market and this had already happened, I missed the breakout. So if I miss the breakout, I'm just going to sit back and be patient. I'm going to let the candles come to me. The moving averages is you. Let the candles come to you. And when they came to me and they crossed a little bit, I'm waiting for a candle to cross back and close above this 50. This next candle open above this 50. And I'm going to go ahead and go long. And I'm going to catch it from here all the way to here. Then obviously you saw this. So that lets you know that market structure what was changing. Okay. So again, you don't chase candles. You want the initial breakout. Here's what I tell you. If you got into the trade here and it started to break out, you notice that the 50 moving average line crossed over the 200 moving average. Now that is called a bullish cross. So if you are already in a uptrend trade and a bullish cross happens, it usually is going to be a stronger move to the upside. Okay? And so you can trade both. You can trade the price action breaking out, which is what I trade, or you can wait for a cross. Now, the only problem again is with the cross, it's a lagger. So that means that usually by the time the line and cross, you missed all this, but you might have got in here because it's a lagger. And so that's why I use price action. I use the candles. That's about as current right now as you can get. It's the price action. So here's an example. Here, prices went up. It pulled back. Then the prices did what? It broke across both lines. And when it broke across both lines, it went down. Now, in this case, I didn't take the trade because I can't get a 2-candle confirmation. This is the first candle. I needed it to close and another red candle to open and go down for me to get in the trade. And that's fine, because guess what? This really was just a pullback. Why else would I not be shorting? Do anybody know why I wouldn't be shorting? Somebody type in the chat why I really don't want to short. Do anybody know why I don't want to do no shorts? Even if I can. Thank you, Sandra, Chantel. Yes, yes, yes. You're in an uptrend. So what did I say? Don't go against the trend. Just sit back and wait for it. Until that trend changes to red, don't short. Because if you short, even though right here, it fell down, then here I did a short, I still could have made a quick scalp money. It ended up going all the way down to here. But it wasn't a big move to the downside because the trend was still green. Okay, so that lets me know it ain't trying to break all the way down. It's just going to do a pullback. Now, when the candles are in between the lines, like see this right here? You see how these candles are moving in between the lines? Don't trade. Do not trade. Do not place any trades in between the candles, because guess what that means? The market is consolidating. It is moving sideways. So if you try to trade in between the bands, 9 times out of 10, you're going to lose some money. Yes, you are. You're going to start losing some money. So you only want to trade the direction of the trend. Remember, you want to get on the train and ride the train. If you do the opposite of the trend, you are stepping in front of a train thinking you're strong enough to stop it. You're not. Okay, so remember, when price action is above the moving averages, you're looking for buy opportunities. If you miss the breakout, wait for the pullback. Wait for it to get close to the moving average and wait for a bull candle to happen. And then go in and take a trade. All right. Also, let's say if you're in a trade down here at the bottom, let's say you got in right here and you're going long. So you're making all this money. Then you obviously see there's a pullback to the moving average, and then you're ready to get back in because it's going to continue to trend up. You can hit another position. So now you can be in two positions. So instead of trying to trade high lot sizes, you can trade lower lot sizes but have multiple positions open. So now you doubling up, and then you riding it up. Okay? So again, if you're already in a trade and then a cross happens with the moving averages, it's usually going to be a push further. Okay? Always trade with the trend, never trade in between the bands. Yes, the band is always real time. It's always real time. You do anything outside of this, you might get lucky, but you're going to start losing. Trust me when I say you're going to start losing. And so again, even though price action can be above the moving average, these candles is what you better be paying attention to. This market, the market structure. When they start to do them long wicks, create them lower highs, you know that that uptrend is about to end and there's going to be a pullback. And even though the market is green, it's a pullback. You're just waiting for price action to go back up across the lines and get in to your bull run. Until that trend bar shows a speck of red, you're still looking for buys. Again, this is the same thing I just talked about. Your first trade is when the candles cross over. You do a buy. You do an up. That's your first trade. Let's say you got out. It moved up. It started falling down. You got out the trade. You scared. Ooh, I'm scared. Let me go ahead and ring the register. You ring the register. Fine. Once you get out of a trade, that's it. Until your setup comes again. Don't jump back in. Because when you jump back in, then you go from being a smart trader to a gambler. Because you don't know how far it's going to go up. You don't know how far it's going to go down. So if you just jump out there blindly, you're gambling. Let it retrace and fall, pull back, and retrace back to the 50 moving average. And then you can get in again and take your second trade. And you still made the same money. Then trying to jump in here because you think it's going to go up some more. And now you got to sit and wait through this whole pullback and wait for it to come back up for you to even get in the money when you could have rung your register, let the markets come to you and get back in and been in the money. Okay? Resistance and support. And again, on a video that I'm going to drop tomorrow, you'll see exactly how I draw my resistance and support. So like I said, I draw my critical price points off of the daily. And all I'm doing is I'm drawing a horizontal line at the highest price. I pull up the daily chart, horizontal line at the highest price, the lowest price, and then I go in between. Do I see areas where price action pretty much, where multiple candle sessions hit a certain price point more than 2 times? So more than 2 times. These are 3 candles that hit the same price. And it seemed like when it hit that price, it moves up. It don't go past the price, it moves up. So what does that mean? That means that this is a strong support. That means that when price go up and it goes down, it stops right here and then it makes its way back up. It don't break down and go all the way down to the bottom. This is a new support. This line here, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, a whole bunch of candles falling on this one. So I'm literally going to draw a line here. These are critical points. Now, to make it easier for you, you can color code your critical points and make them a different color. Like you can make your critical points pink. That way you know when they get ready to hit, it's usually going to be a move. So look at this. You see how this candle broke up and it hit this, it went through this resistance. But the reason why it failed and created this long wick is because this is a strong resistance price point. And if we look back into prior candles, there are some more candles that's right on this line. It hit the wall, cracked it, but it had to come back down. It had tried multiple times to break through, but it keeps falling back down. That's a strong resistance line. Okay, so let's say that I'm trading. All right, again, I got my critical points. This is the low. Let's say this is a reversal candle from the downside and price action for the move up. The price went up and then it got choppy. It went up, it went down, it went up, and we waiting for it to break either up or down. In this case, it broke up. So when it broke up, let's say you did a buy. I'm not even talking moving averages, just pure price action, because you should understand the market structure and resistance and support. If you understand that, you can trade anything, any asset class, whether it's stocks, whether it's Bitcoin, it's gold, it does not matter if you know resistance and support. Okay, so you did the breakout, so you did a buy. Your resistance when you are buying, meaning that you bought low and you moving up, this line here is considered resistance. Your resistance line when you're buying is your first take profit. So when somebody asks me, when do I get out of a trade? This was the first one. So this was your first take profit. The next resistance line is your second take profit. Your third resistance line is your third take profit. By using resistance as your take profit, you will literally end up staying in a trade longer than scalping, especially if, and that's only if, you are trading with the trend. If you are buying in a downtrend, this probably ain't going to work for you. Okay, stay with the trend. So again, you'll take your resistance is your take profits. Always remember that when you are buying. Now, once it hits your take profit right here, you can ring the register and take your money because you got in at the bottom here. Now, if you got in right here, then there may be a problem because obviously this is your take profit. I never get in a trade, even if it's initially crossing over the moving averages. If there is a resistance right here, and this is the candle, I never take that buy right here because you always got to be mindful of the risk and the reward. If this is my take profit, why would I get in this candle? Because if I get in the candle right here, I ain't make no money. I ain't really make no money. So what I'm going to do is I'm not going to buy right here. I'm going to let price action do what it do. So I'm going to wait. And then next thing you know, it broke up past this and stayed above here. I'm still not buying. But it went up. It went up. It hit my second take profit. That's cool. That's a strong resistance. It pushed up and it fell back down. And then what is it going to do? It's going to go back and retest that area. This area right here. It went back and retested it. So now I can buy. So again, if I went and did a buy on this candle, I'm chasing. Because you have no idea how high this was going to go. You just chasing. So I'm going to let it go and create its high. And I wanted it to come back down to this resistance level, retest it so that this resistance turned into support. And once it becomes support, I'm buying right here and go ahead and get my second take profit. That's what I'm going to do. Okay, so now I got my second take profit. It moved up. I'm not chasing, letting it establish its high, whatever it's doing. It reached my third take profit. That's awesome. Then it pulled back. It pulled back. But right here, it broke through. So I'm like, oh, I can't buy. Then it went back up, closed above, and now I'm looking at this candle. This candle broke down. It opened high, and it broke down. but it went through the line. Okay, well, I don't know if it want to make it support. This one came, broke up, stayed above, and then this one opened right here. Okay, I'm gonna buy, and I'm gonna go here. Now my intention is to hold it open to get to this third take profit, but guess what? You get out when the candles tell you to get out. And what I realized is the candle started to stall, and it's stalling right here, and it's creating a lower low. Broke down, moved sideways. You already knew what this move was because this one created a lower low. So I'm out the trade. And then it went down, it broke through, went up, and then this is going to be support again. Get in here, doing a buy, and I'm waiting for this to go all the way up. If you understand market structure and you understand the power of resistance and support, a lot of people trade resistance and support wrong. Most people counter trade resistance and support. Now, I'll tell you, I used to be the queen counter trader. That means that when it hit resistance, I would automatically hit sell. Because I'm like, I know when it hit resistance for the first time, it's going to fall back down. So I would hit sell right here and let it fall back down, make me some money. Do a buy off here, make me some money. Hit sell again, make me some money. But guess what? When I hit sell this time, it went up on me. That's why you don't counter trade. Because the thing about counter trading is you can make some good money, especially when the markets, I'm good at when the markets free fall down. I let the markets establish what the lowest low. And when the markets go back and test that low again, baby, I am in it with a buy. I'm buying as low as possible. And I'll ride it all the way up to the top. But I'm an experienced trader. But what I know is that when you are doing more counter trades than trend trading, you're going to start losing money. And it wasn't until I started blowing accounts till I started saying, you know what, Angie, stop counter trading. I know you make big money counter trading, but please stop it. When you lose $14,000 in a day, one day you'll stop. And when you get tired of donating money to the markets, you will stop. So what I'm going to say to you is if you want an 80% win rate, trade the trend and treat your resistance as take profits. If you're selling, let's say you're selling, the market did an uptrend, it moved up, it went all the way up here. Long wick at the top, let you know that the price, the higher price action is being rejected. Then it fell down. It fell down right here. I'd have been looking to see if it was going to establish this, but it broke through. And then it moved up, and then it stalled. It didn't go all the way up here. It stalled. And then another candle, lower than this candle. So we got lower highs here. What that means? That means that the market is about to fall. So what am I doing? I'm getting buying out of my head. Don't buy. Because the market structure is telling you that it ain't going back up to this resistance. It's finna fall down. So I let it fall down. So it fell down. It fell down. Now these are my support on your chart. Your support is red lines, I believe. So I'm shorting because I know it's finna short. Short, short, holding it open. I'm doing me a take profit right here. So I can get out. It did a pullback. It fell down again. It went down. It went sideways. It went down. It hit my take profit, but I'm not selling. I'm going to let it go back up to this top here because I want to get in high and go down. So when it got close to back up here, short, short, sideways, test this up here, short. You see this? Sideways, break down. It got close to my take profit. I'd have grabbed it here. Did a pullback, fell down, but it didn't go all the way down. Now it's in a channel and moving sideways, going up and down, waiting for a breakout. It broke out, and then it went to the take profit again. Got a reversal candle, consecutive bull candles, letting you know that it's trying to break that downtrend, move sideways, down, and then that big old engulfing candle, move sideways, and when it broke over this prior low, high, however you want to call it, lower high, now you're ready to buy. And the market is going to move and go back up. And when the market go back up, what was my support is now my resistance. Take profit, take profit, take profit. Okay, so your resistance and support is your take profits. Don't counter trade. Do not counter trade. And don't counter trade. The only time you counter trade, you see something like this. The long wicks at the bottom, long wicks, you see this long wicks at the bottom, long wicks at the top. That you might be in a counter trade, but you gotta let it come to you. Don't guess. All right. But that's how you know when to get in and when to get out your trades. Again, you looking at your support. You got a long wick candle at the bottom that's letting you know it ain't gonna fall down no more. It's a reversal, up, sideways. It went up. It opened up here. Now, usually I say buy, but I would not buy because it's too close to a resistance level. So that means it could have hit here and fell all the way back down. That's why I don't trade when I don't do a buy if the candles are real close to a resistance. I let it break through. Let it break through, all right? Sideways, break up, down, sideways. So start looking at the market as you are looking at your charts. Look how the candles move towards your support and resistance. Look at how the candles move when it falls under the moving averages. Look at the candles when they go above the moving averages. Look at the movement. And everything that I'm saying to you is actually going to happen. So tomorrow's video will look something like this. I am going to show you how I set up my charts. And like I said, I like a black background. That's what I trade off of, a black background. My candles are not green and red. My candles are pink and white because that's what I like, okay? So as you can see, I got my moving average. I got my 200, yellow. I got my 50, and it's purple. You can see that I got a critical point drawn here. That actually, even though this is a 5-minute chart, this critical point was drawn off of the daily. So when you draw off of the higher time frames, the lines are going to move to the lower time frames. Now you probably have to shrink your chart down to kind of see all the lines, but when it's zoomed close, you ain't gonna see all the lines that you draw. But this was a critical point that I drew off of the daily. These lines here, these little dotted lines, this is the Fibonacci indicator. This is your intraday resistance and support that you're going to use when you're trading the 5-minute. And so that intraday indicator is going to give you 7 lines. You're going to have 3 lines that are green at the top that's labeled resistance. You're going to have a blue pivot line, and which is where all of the other points are calculated from this pivot line. And then you're going to have 3 red lines at the bottom, and this is going to be your support. Okay? Now, look at your trend indicator. What does the trend indicator say? It says, am I in the uptrend? I'm in a downtrend. I'm in a downtrend. So that means all I need to be doing is what? Looking for opportunities to sell. That's it. That's all. So, as you can see, if I'm moving from the left, price action was slowly climbing up. When you see candles like this, that's really, really tiny, that means it really ain't no momentum in the marketplace, and that whatever trend was the initial trend is starting to lose steam. Okay, so even though it's going up slowly. Now the candles and got up, going up and down this line. I'm not trading this. This is sideways. This is all sideways. I don't take any trades in between the bands. It's all sideways. You know what else I noticed? Again, you don't want to trade in between the bands, but you see how the price action hit my critical point. When it hit my critical point from my daily, I knew that price action eventually was going to fall back down, because when it hit the critical point for the first time, that's just what's going to happen, right? Remember, throwing the ball to the ceiling, it's going to fall down. So this was my critical point. Now, most people would have saw this and wanted to do a buy. Not me. I'm not buying on no critical point where it first hit a critical point. And look at my resistance, this pivot. These candles too close to the critical and pivot. I don't want to do any of that. If you do that, you'll find yourself buying and the whole market fell on you. So that's why it's important to understand market structure, and sometimes understanding when the candles are in between the bands, being mindful of where your pivot and resistance and critical points are, so that you can take better trades. Zoom out so you can see the bigger picture. Then right here, it tried to break again, and there go my wick. But guess what? Look, this is a lower high. It's lower than this. So what that's telling you that the uptrend is doing what? It's about to end, and it's about to go down. And now all I'm doing is I'm waiting for the candles to fall below both the yellow and the purple. And there you go. This one fell below, it closed. Remember, I do a 2 candle confirmation. That's just me. If you feel better just jumping in as soon as it closed, that's on you. The reason why I don't is because sometimes it'll go down and then move right back up. So I do a 2 candle to try to give me a better win rate. Again, it's only 80% right, but I'd rather be 80% right than 80% wrong, right? So this candle closed and went under both lines, it closed. And then when this candle opened, it was still underneath both moving averages. I'm finna sell. I'm selling right here, and I'm riding it down. This could be my take profit, but I'm going to leave this trade open. You know why I'm going to leave this trade open? Because my trend is red. So I'm going to leave it open because I'm just going to flow with the market. It did a little pullback, broke down my support, went down, move sideways. And if you look at the trend bars, they're getting longer and longer. That means your move is getting longer and longer. Now, if I wanted to, I could get out right here because this is a take profit. My support is a take profit. But because I got in way up here, let's see. Let's see. It broke up, broke down, went down. Okay, I'm in there sideways because I'm seeing a staircase down, stairways. I'm holding it open to the next support. There you go. Literally, the candles came to you. Sometimes it's just being able to wait for them. So you had 3 places to make money. You could have scalped right here, caught a quick scalp, pulled back, broke down. It went back and tested this. Now you short, go down to here. You could took profit, went down. It went back up and tested it here. Now I'm shorting because I'm still in the downtrend. Go down, sideways, boom, I took profit. So I could have got paid 3 times or just one big old time. Now, the sooner you catch a trade, the longer of a move you can take and you might catch, all right? Always be prepared to ring the register. It hit your support, ring the register. Stacy had $2,000, but didn't ring the register and only had 700. Now 700 is still good, but 2,000 would have been better. Ring that register. It went down and hit support. And here's something that you need to notice with the RSI. The RSI lets you know when the market is getting to a point where it's starting to possibly do a reversal. You won't know when the reversal is going to happen. You got to let a candle tell you. But you notice as the price action went down, this moving average, not this moving, this RSI line, the top part is 80, which means that the market is oversold. When the markets are oversold, you're going to be looking at your candles to see, are they hitting a resistance level? Is it starting to fall underneath the 2 moving averages? And it's going to be a downtrend. And it went down. Now, if I look at my RSI, this blue line is down on the 20. That means that the market is overbought. Okay? And what does that mean? I got them mixed up. I'm sorry, it's the opposite. The market is oversold and it's time for a reversal. Look up. It went down, it hit your support line, and now you see that 3 consecutive bull candles. That's an indication. Look at your RSI. The market is oversold. It's time for the bulls to get in the market and move that price up. So it went up, but I'm still in the downtrend. So when the price action did the pull back right here, I could have did another sale, let it move. It didn't go all the way down, so that means it's creating a newer high. So that's letting me know that my trend is about to break. This is today. Then it moves sideways, and then price action is trying to make its way above. Now, once price action up in here, now you see how these candles keep hitting this support and falling down, hitting the support and falling down. That's why you ain't doing buys. You don't do no buys. Don't do no buys when the trend is red. Just let the markets do what it's going to do. Let it go. Once it's up in here and it's in between these two lines, I'm not doing anything. I'm not doing no buys until price action is above the purple and the yellow. As long as the trend is red, I'm always going to be looking for opportunities to short until it changes. Okay. And so again, I'm gonna do a video. I'll drop it in the group tomorrow for people who do not have their chart set up yet. I'll show you how to set your charts up, and this is how you trade, you guys. And so your homework is to make sure that your charts are set up. If your charts are already set up, make sure you understand how to draw resistance and support. And when I drop the video and I create the chart, I'm gonna show you how I do resistance and support. So if you don't know, you're gonna know tomorrow. And again, if you're new, start taking some practice trades. Possibly take your first practice trade on Friday. For the people who already been in the classes, trade. That's the only way you're gonna learn. And for those that are trading live, again, make sure your mind right. Know when to ring your register. No trading in between the lines. No chasing candles. Follow the strategy so that you can get an 80% win rate. All right, you guys. Woo! Now, see, I call myself making this shorter, and it still went long. My goodness. But okay. So that is going to end our training for tonight. I will get this replay video uploaded in the group tomorrow. And again, on my to-do list is I am going to shoot those 3 videos for you guys. And I'm going to drop them in the group. So, all right, you guys, thanks for being on today. And I will see you guys next week.
Thank you, Angela. Appreciate you.
All right. Good night, y'all.
Good night.
Good night.
Bye.
Bye. Bye, Q.
Thanks, Angela. Have a good night.
Yes. Yeah, Stacy, I was talking about you today. Thanks for being on, Marta and Carmen. Y'all hurry up and come on.
Night, Angela.
Hey, Atricia, how are you?
We coming.
Yeah, I hope y'all is coming. I ain't messing with y'all all day. Come on, get them trades in so y'all can get this money.
Good night.
Good night.
Right.